Treasury yields higher every single day this week. Monday, Tuesday, Wednesday and this morning, Thursday. Equity futures softer, negative by a third of 1%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, the bond market hitting some turbulence. The BOJ stepping in for a second time this week, and two tech titans gearing up to report. We begin with the big issue, an excuse to sell or a reason.
Looking at this sell-off,
this is, in a way, an excuse to maybe even take some profit.
It's been the perfect storm over the last 2 days.
You had the Fitch downgrade,
followed by bigger refunding announcements in the U.S.
You throw in some strong economic data in there.
We've got a lot of other stuff to get through this week.
The employment report on Friday.
150 companies in the S&P 500 reporting earnings.
The timing is so galling in some people's mind.
There's no change in my view in terms of the relative attractiveness of yields.
This rally we've seen this year has been so strong.
Frankly, I think the market was overbought.
A lot of it has been a fear of missing out.
This one-day sell-off, I don't think it's going to be very big.
At the moment, the likelihood of a recession is pretty small.
That slowdown's coming along.
Whether or not we end up getting a recession this year, is up for debate.
Following the biggest one-day drop since April on the S&P 500, joining us now is Bob Dole of Crossmark, Mona Mahajan of Edward Jones. Mona, first to you, is the downgrade, the bond market move, a reason to sell or an excuse?
Yeah, you know what? We're leaning towards the excuse category as well. And keep in mind, the S&P has been up nearly in a straight line since March of this year, 18%, the NASDAQ up 25%. There's really no arguing that we were due for some sort of pullback. In fact, a pullback in our view was probably not only due, but healthy. So we could level set, we could reset, and we could position potentially for a move higher. Now, what we will say more broadly, the Fitch downgrade does highlight an important point and a long-term point in that, of course, as debt in an economy increases, government is spending more on interest payments, less on productive parts of the economy like R&D and infrastructure. And over time, that can have an impact and a negative impact on potential growth. But in the near term, the U.S. economy continues to power through, or in fact trending towards above potential growth here for the first 2 quarters. We have a Fed that potentially is stepping to the sidelines. And by the way, inflation metrics are starting to meaningfully move lower as well. So we don't see this as an imminent threat, a good long-term call out, and probably an excuse for some market participants to take some profits.
Well, the moves continue this morning. Yields higher on the 10-year by 9 basis points now. Your 10-year at a new high for 2023, just short of 420. Bob Dole, can we diagnose the sickness in the bond market? Is it due to what happened with Fitch? Is it due to the additional supply from Treasury, the better ADP report yesterday, the fact we're all dazed and confused by whatever the BOJ is doing? What is it?
Yes. And I'll add a couple other things. If there was going to be a recession, it's pushed to the right. A lot of people have pushed it off the table. And believing inflation is stubborn is the excuse some people give. We've moved from 372 to 415 in the 10-year in a couple of weeks. Remember, the high was 435 last October. And I saw one technician this morning saying we could be setting up for 490 or 5 for the 10-year. That's a long way from here. I don't think that's a gimme, but upward interest rates are not great eventually for economic growth. And they're certainly not good for PE ratios when they're in the 20s.
Bob, does it matter why they're there, or just that they're there?
Oh, it matters why they're there. No question about it, because why they're there helps you understand where they might go next. And I, for one, I've been cautious for a while here, and still think economic growth is going to slow. The lending standards getting tightened, the leading economic indicators. You know the litany, Jonathan.
Yields up again across the curve. I'll go through the numbers again for you if you are just tuning in. Up by 3 basis points on a 2-year, 490. On a 10-year, up 8 basis points, about 416. If you remember, the high of the post-pandemic cycle goes back to October through 430. So not quite there yet, but still at the highs for 2023. Joining us now is Ira Jersey of Bloomberg Intelligence. Ira, you can blame the downgrade, the data, the BOJ, take your pick, the additional supply out of Treasury. What are you and the team doing?
Yeah, so, well, it's all of those things for sure, Jonathan. But I think, a lot of this started really with the additional supply, with the $1 trillion being raised just this current quarter being announced, which was a couple $100 billion more than a lot of us thought. So clearly the fiscal deterioration and the extra supply is something that's going into a less liquid time of the year. If you're taking a holiday this year, it's going to be hard to be long. So I think you also have some position squaring here. You have a lot of people who, had been long thinking that, maybe we were going to have a recession later this year. So when you see some of this data coming in a bit better than expected, maybe it's time to get flat, go on vacation, come back and reassess in a couple of weeks.
Ira, if Chairman Powell sits down to deliver a speech in several weeks' time, I imagine he will. If he's writing that now, what do you think that's going to sound like month end?
Yeah, so I do think it really depends very strongly on what happens with some of the information that we get, some of the data. It'll be interesting to see what Chair Powell is going to be talking about during the Jackson Hole Symposium. Is he going to be very highbrow academic, or is it going to be more monetary policy focused and maybe signal that, hey, maybe we're done hiking? But it's hard to, I think, at this point to show that when you have such a mixed data set. Even the data we received this morning, the job market's still very tight. That's not a problem for the Fed right now, except insofar as wages keep on climbing. So I think that Jay Powell is going to have to continue to walk a fine line, and I think hit harder with the idea that we're not going to be cutting anytime soon unless we have job losses and inflation's lower. The market is starting to get the hint, now not pricing a full cut until well into 2024. But I think in a way he would love to get some of those hikes priced out. And that means that things like the 5-year note probably needs to be where it is, and maybe even have somewhat higher yields than where they are.
The 5-year right now up 6 basis points. Sarah, just to finish on this, the BOJ. Do you think about the BOJ lifting the anchor, the final anchor around the neck of the global bond market? Is that a new floor for yields worldwide, or are we thinking about a new ceiling?
I think it's probably has to be a new ceiling, certainly for the OECD countries, and one of the reasons I think that yields globally are selling off a little bit is because of the yield curve control actions by the Bank of Japan. Because if Japanese yields are somewhat higher, and that means that you have an investment alternative, and you wind up having less demand from private investors in Asia coming to the U.S. if they can get any kind of yield out of a local currency sovereign bond market like Japan.
Ira, thank you. Ira Jersey on the bond market. Mona, this year to date, some big gains in the equity market from big tech. After the close, we'll hear from Apple, we'll hear from Amazon. Year to date, Amazon up by something like 53%, Apple up by something like 48. As we know through much of this year, Mona, for big tech, for the market as a whole, a lot of it has been multiple expansion. What's the relationship between this bond market and equity valuations?
Yeah, it's an interesting point. And look, initially we saw as yields were moving higher, as the Fed was really moving aggressively, that was a headwind for tech and large cap tech in particular. And we saw that play out much of last year. Rising yields meant bad news for longer duration assets, including technology stocks. This year, we've seen a bit of a reversal. First of all, treasuries have not moved at the same pace they moved last year, but really technology has had some sort of tailwinds behind it. Not only are we seeing better earnings growth out of the group broadly, a rebound from what we saw last year, we of course get that cherry on top with the AI and the enthusiasm around AI. Now, to your point, a lot of the enthusiasm we've seen has now been priced into the stocks. Valuations do seem stretched on a lot of different metrics. And in fact, when you take out, what we're calling the Magnificent Seven and look at the S&P 493, valuations look a lot more reasonable amongst those stocks. And so what we'd say going forward, don't wholesale give up on tech. We do think AI is in the initial phases of a long-term secular bull market. But you have to think about broadening out the way that we think stocks continue to rise, perhaps after some volatility, is by the broadening of leadership to include areas like cyclicals. We're starting to see small cap show some signs of life, even international and parts of EM. So we do think one of the themes for the next 6 to 12 months will be this broadening of market participation, driven by better valuations in the rest of the market.
Bob Dole, let's talk about that. Should I be concerned about the narrow leadership of some of these markets? Should I embrace the winners or just look elsewhere?
I agree. The broadening out theme one needs to play. I'd add to the list that was just given financials, energy stocks, they're beginning to participate here. They're pretty cheap versus the rest of the market. If that broadening turns back to narrowing, that's problematic for the market as a whole.
What did you make of yesterday then, Bob? Yields up, banks lower. Yields up and defensives outperform. Staples, healthcare, utilities. What's the message you take from a session like that one?
A very clear risk-off day, way overdue probably. Look, if interest rates are going to keep going higher, that's a challenge for the equity market. That's a challenge for cyclical stocks. And PE ratios cannot stay in the 20s if 10-year yields are going to move north of here.
Bob Dole, Mana Mahajan sticking with us. Equity futures right now down by 0.4% on the S&P, with some movers going into the opening bell. Here's Abby.
Well, John, the results that Expedia just reported not helping the market mood right now, because gross bookings for the second quarter miss. We'll need more detail on whether that's the weakness that we're seeing here in the U.S. as consumers travel more internationally. But you can see shares absolutely plunging down 10.6%. But that's not the only earnings laggard that is weighing today. Qualcomm down on a tepid forecast for the current quarter. Of course, the chip maker heavily dependent on some of the big phone makers, including Apple. Interesting tell, perhaps ahead of the Apple quarter. Cell phone demand is not great. That stock also down almost 10%. PayPal down 9%. Transaction margins under pressure. The adjusted operating margin of 21.4% in the quarter that was just reported fell from 22.7% in the prior quarter, so not making as much money per transaction. And then finally, rounding it out, Robinhood down about 6%. They put up a surprise profit, John, but their monthly active users of 10.8 million, well, that was almost a million shy. Investors not liking it.
Abby, thank you. I want to draw your attention as well to what's happening in the commodity market developing in the last 20 minutes or so. Crude is higher by 1.2% on WTI, on Brent up by about 1 percentage point. Some news out of Saudi Arabia extending its unilateral oil production cut by another month, so an additional month, and said it could be prolonged even further or even deepened. So crude positive off the back of that. On Brent, 83.95. On WTI, $80 and about 40 cents. Coming up next, payrolls just around the corner.
The real narrative is we continue to see the U.S. labor market as being very strong and buoyant. And I think the underlying driver of that is the U.S. consumer spending on services remains very strong.
We are looking ahead to tomorrow's jobs report. That conversation up next.
For us, unemployment is a lagging indicator. Unemployment is confirmation that we're not in recession or confirmation that we are in recession. We still think we're headed for recession sometime around year end, and until we're in recession, unemployment will, yes, remain low.
The brilliant, the fantastic Bob Michael of JP Morgan Asset Management weighing in on the likelihood of recession and the state of the U.S. labour market. Weekly jobless claims still near the lowest levels of the year, but rising slightly ahead of tomorrow's payrolls report. The U.S. is expected to add 2,000 jobs, lower than the previous month. Unemployment expected to hold steady at 3.6%. Mike McKay has the preview. Morning, Mike.
Good morning, John. Well, we got some numbers today that do support the idea of a still tight labor market. Jobless claims rise only a slight amount, 227,000 up from 221,000, a gain of 6,000. And the continuing claims number, which everybody's watching because that really tells you where we are in terms of unemployment, just another slight increase. But we did get some very good news ahead of the jobs report, and that is non-farm productivity rises 3.7%. That's the most since 2020 after being down 1.2% in the first quarter. That pushes unit labor costs down to just 1.6%. And here's why that's important is the productivity decline has been making things much worse for companies, and the idea that we get productivity higher means that we can absorb higher wages. So we'll be watching those average hourly earnings. You mentioned the forecast for payrolls and unemployment. Average hourly earnings expected to fall back just a little bit, the increase slow, and if that is the case, then this will be good news for the Fed. The issue for the Fed, of course, is that they don't meet again until September 20th, so this isn't going to be a dispositive kind of jobs report.
They get another one, a CPI report, two of them actually, and another payrolls report in addition to that one. Mike, do you think you can make the case that they're making progress based on the data we've seen so far? Job openings, the quits rate, what you're seeing develop just in terms of the rate of growth in payrolls. Are they making progress?
Well, you could argue they're making very slow progress on the labor side of all this. Inflation has come down quickly. Now it is forecast to slow down. The problem is nobody really knows what's going on. Tom Barkin, the Richmond Fed president, with an interesting speech today saying that we're still feeling the effects of the pandemic in the economy, and we don't know exactly what's going to happen because it's had such weird effects. But you know, John, the most interesting thing he said was that this recession that people are talking about has been predicted for so long that companies have been able to adapt to that already. They're holding on to workers, they're cutting their expenses, and we see that with productivity and unit labor costs. They're getting ready for it, and so maybe we avoid a recession because everybody's so prepared for one.
How is any of that compatible, Mike, with this idea that we get back to 2%? How is the labour market at the moment consistent with the idea that we get back to 2% CPI inflation in America?
Well, historically, it's not consistent, but this is an anti-historical or an anhistorical kind of recovery. We're seeing things happen that we haven't seen before. The fact that inflation's come down so much without unemployment rising, even if, as Bob Michael says, unemployment's a lagging indicator, that's not what the models would tell you should be happening.
Mike McKee. Mike, thank you, sir. As always, looking ahead to payrolls. The estimate tomorrow, 200K. Mike's going to join us a little bit later this hour to break down the PMIs in America. I believe we get an ISM as well out of the US in about 40 minutes or so time. Bob Dole joins us now, Mona Mahajan alongside him. Bob, the idea that we can get something from earnings, can we just start here? The likes of JetBlue telling me that the US economy isn't as good. The likes of Caterpillar saying that the international economy isn't as bad. What can you take away from earnings currently?
Mixed, as you just pointed out. When you look at forward earnings expectations, full year 23, full year 24, not changing much as a result of the less bad than feared second quarter, same as the first quarter. So I think it's saying earnings are mixed, and I agree. Employment, as you just talked about, is at best a coincident, more likely lagging indicator. The lead indicators are pointing to the economy is going to slow down.
Mona, are things slowing down or getting better?
Yeah, it's a good question. And look, I think there's a dichotomy in the U.S. economy right now between manufacturing and the services economy. And you could argue manufacturing, which, by the way, has been in contraction, if you look at the ISMs for about 8 months now, that may be starting to bottom, trough, and showing early signs of recovery. Services, on the other hand, have been in full kind of bull mode. We see areas like leisure, hospitality, travel, this continued consumption and demand for those services here in the U.S. and really globally, we're seeing a similar theme. That we have yet to see kind of a peak and soften a bit, but we do think, especially as we head towards the end of the summer travel season, we could see some softening. You know, interest rates are high. We are seeing a little bit of cooling in consumption if you look at the GDP report from Q2. And, you know, some of the early indicators in the labor market, including, as you noted, lower job openings, a slight rise in jobless claims, are pointing to softer labor ahead. Now, we'd also just point out briefly that some of the pandemic distortions are still with us. You know, a lot of people left the labor market during the pandemic period. Many of them haven't returned yet. We also saw a lot of stimulus during that period, and consumers are still working that down. So this is a unique cycle. Consumption has remained strong. The labor market has remained strong. But over time, we think perhaps what we'll get is a rolling kind of recessionary environment, or maybe even just slowdown in that manufacturing already went through it. Maybe services has to soften a bit ahead.
Mona, build on that a little bit more. The factors behind the resilience so far, which factors can you identify are fading at the moment? Which ones are fading?
Yeah, you know, the services one is what we're watching most closely, and we haven't really seen a meaningful fading in that yet. But, you know, tomorrow's jobs report will be telling. If we continue to see wage gains cool, even if the labor economy remains strong, that's one we're watching closely. You know, the Fed has kind of told us they'd like to see wage growth fall from about 4.2% to 3.5% to kind of make their 2% inflation target. So that's what they're watching for. And we think if wage gains can cool, that kind of indicates that the labor market, you know, you can't switch jobs and automatically get higher wages. Maybe employers, even though they're holding on to employees, aren't giving them the same level of wage growth we've seen in the past. And that will have a cooling effect on consumption broadly. So we'd say watch those wage growth figures, earnings figures, as an early indicator of softening in services and consumption.
Bob Dole, do you agree?
Yes, I do. Watch for those slowdown signals. We've seen some, as was pointed out. I think we will see more as time goes by. Employers I think are going to be a bit concerned if, in fact, the lending standards make it tougher for those small businesses, which are the net adder of all jobs, continues to tighten, and that will slow things down, and that has a bit of a ripple effect.
Bob, before you go, top picks right now, what are they?
So I want to be in companies that have high earnings predictability, high earnings persistence, reasonable valuation. I want some value, but not just because it's cheap. It's got to have quality. I want some growth, but I'm not going to overpay for it.
Mona, what about you?
Yeah, similar. We talked about the broadening of participation in equities. We'd say make sure you're balanced there. I'll also just make a quick point on fixed income. We think there's an interesting opportunity forming in investment grade bonds. You're not only locking in these higher yields for longer duration, but potential for price appreciation if the Fed over time does pivot lower. So definitely a part of your portfolio.
Mona, Bob, thank you to the both of you. Going into the opening bell about 7 or 8 minutes away. Equity futures right now on the S&P 500 negative by 0.4% for a fourth consecutive day. Every day this week, yields higher. Your 2-year up by 3 basis points to 491. Your 10-year higher by 9 basis points now to 417. Your 30-year up by more than 10 basis points to 428. Quite a move over the last week or so. Coming up next, the morning calls, and later, George Concalves of MUFG joins us around the opening bell, and we'll look ahead to Apple and Amazon earnings with D.A. Davidson's Tom Forte. All of that and more still to come from New York City. Your opening bell, 7 minutes away. Yields up, stocks down. It's been a story of the last day or so, hasn't it? It repeats again this Thursday morning. Good morning to you all. About 5 minutes away from the opening bell, equity futures on the S&P negative here by 0.4%. Down again on the Nasdaq, we're negative by 0.75%. The small caps, the Russell, a bit softer. No real drama, down about 1/3%. That's the story in the equity market. Let's get you some morning calls. Jefferies cutting its PayPal price target to 70 from 75. The analysts struggling to see a positive narrative emerging after the company delivered disappointing earnings. That stock is down, and down hard, by 7.8% to $67.40 in the pre-market. Deutsche Bank downgrading Qualcomm to hold. The analysts seeing challenged confidence in the company's growth potential following weak earnings. That stock is down by 10.5% to 115. And finally, Morgan Stanley raising its Shopify price target to 59 from 54, noting that investors lack direction from the company on longer-term growth. That stock just about unchanged. Coming up next, George Concalves of MUFG joins us around the opening bell to talk about the shakeout in the bond market, plus tech earnings after the close with Apple, Amazon on deck. D.A. Davidson's Tom Forte up shortly. Let's get this session started. Live from New York City. Good morning to you. Equity futures negative here by 0.5%. On the Nasdaq, down by about 0.8%. The weakness there off the back of the weakness in the bond market with yields higher once again this morning. Going into the open then, a little bit negative. There's your opening bell. Switch on the board and get to the bond market. Yields higher here again by 9 basis points to 417. Highs for the year off the back of stronger than expected data yesterday. A downgrade from Fitch. The BOJ looking dazed and confused. Some extra Treasury supply. Really pick your poison, put it all together. And as Bramo would say, a toxic brew for Treasuries. In the FX market, dollar stronger, euro weaker, 109.28. And crude higher today by 0.6% as the Saudis make a bit of a move to extend their unilateral cut in the oil market. Crude up to about 80 on WTI. One stock to watch at the open, it's Yellow. The trucking giant hit with a lawsuit after announcing mass layoffs last week. The complaint alleging the company failed to provide a 60-day notice to nearly 30,000 workers. Abby has more. Hey, Abby.
Hey, John. Yeah, the looming and likely bankruptcy of this logistics company, trucking company, transportation company that shut down on Sunday. Well, it's not the only headache. They also have this lawsuit to deal with now. And as you mentioned, it is basically a class action lawsuit alleging that Yellow and 4 of its subsidiaries failed to give nearly 30,000 workers the required advance written notice before a mass layoff. Specifically last Friday at a Bloomington, California terminal, 600 workers were laid off. Armando Rivera, a California dock worker and union steward, well, he is suing on behalf of a proposed class of other laid-off workers, citing the federal law that requires 60 days. They're also citing California law that similarly cites 60 days. In New Jersey, it's 90 days. They're seeking severance for those time periods, plus in New Jersey, some extra severance. It's going to give, even prior to this lawsuit, this pending bankruptcy, the likelihood, the ability to see whether or not union contracts can survive bankruptcy proceedings. As for the stock, John, from last December's peak, down more than 95%. Last week, it traded in a range between about 40 cents and $5. This is how these stocks go ahead of bankruptcy as investors scramble to figure out what's next.
Brutal stuff. Abby, thank you. About 2 minutes into the session, the broader market negative here by 0.5% on the S&P. On the Nasdaq, down by about 0.5%. Want to turn to earnings briefly. Etsy failing to reassure investors with a weak forecast. The CEO saying this: we believe we can unlock significant growth opportunities. We are aligning our investments and efforts with initiatives that move us towards this vision. Katie saying all the right things. The stock is down 8%.
Yeah, Etsy just having a terrible time this morning. And to be fair, the second quarter went fairly well. You had EPS come in at 45 cents. The estimates there had been for 41 cents. Sales beat expectations as well. And the CEO also said that active buyers reached an all-time high, but it was that third quarter guide that you mentioned that has shares sinking this morning. Etsy left its gross merchandise sales forecast unchanged, and it said that revenue should fall between $610 and $645 million versus the consensus of $631 million. And that was not good enough to impress the sell side. Bernstein out with a downgrade this morning, while Citi wrote that investors are looking for tangible evidence that growth can return closer to its historical levels and that this print, quote, doesn't do enough to do that. And Citi is just one of at least 4 banks that have cut their price target on Etsy this morning. You add it all together, shares off by more than 7% for the year, lower by about 26%, John.
Katie, thank you. Lots of action on the south side. Katie mentioning Bernstein and that downgrade. Here it is on Etsy, downgrading the stock to market perform. The analyst saying, quote, the firm hoped the company's Q3 gross merchandise sales guidance and management commentary could draw a line in the sand on the business returning to growth, but it wasn't quite as reassuring. That stock is negative by more than 8%. Want to turn to a different earnings story. Clorox topping estimates after shoppers absorbed higher prices. The CEO saying this: we're taking the appropriate actions to build a stronger, more resilient company positioned to win in the marketplace and create long-term value for stakeholders. Simone has more. Hey, Simone.
Hey, John. Yeah, Raymond James calling this a big beat across sales and margins. Revenue coming in at $2.04 billion versus an estimated $1.87. Margins 42.7%, well above the 40.8% that the street expected. Mind you, they are still below the 45%-ish range where they were pre-pandemic. There has been an ongoing reorganization to try and cut costs, get those margins higher. Analysts saying this appears to be bearing fruit. You know, it really should be noted, however, that as with restaurants, as with other food companies, packaged good companies, this is really driven by price increases, not volumes. Volumes actually declining by 2%, while price growth up 16% on a year-on-year basis. Also, notably, executives projecting a recession in the early part of the next calendar year. They say that's going to limit the amount of additional price increases they can make. They don't see any beyond the next 2 quarters. Also going to have to increase some promotions. Also flagging some ongoing concerns around labor costs, cost inflation. Litter, one, they say they just can't keep up with demand in terms of the supply that they have on offer. But as of yet, seeing a strong day so far, up more than 7% in shares.
So far, so good. Simone, thank you. So far, so bad for the chip makers. Qualcomm delivering a mid-sales forecast on weak smartphone demand. The CEO saying this: we will be proactively taking additional cost actions to ensure the company is well positioned to deliver maximum value in an uncertain environment. Ed has more. Morning, Ed.
Yeah, good morning, Jonathan. Qualcomm down almost 10% after the open had fallen as much as 11%, which would put it on track for its biggest drop since March of 2020. The story here is that Qualcomm is the largest maker of smartphone processors in a smartphone market that is continuing to experience its most severe slowdown for a long time. That weak sales forecast you mentioned, $8.1 billion to $8.9 billion in the current period. The midpoint of that range is below the $8.79 billion that the average analyst estimate was expecting. Qualcomm forecasting that overall the market for smartphone handsets will decrease by high single-digit % this year versus 2022, you look at that versus the prior 2 quarters of commentary, it does represent a modest or slightly dimmed outlook overall for its main market. The commentary is that handset manufacturers are continuing to work through inventories and are not placing new orders for those smartphone processors or modems, and that is going to continue until the end of the year. That is the assumption that Qualcomm is working to. As you mentioned, the cost reduction program that Qualcomm has responded with does include headcount reduction, and in the quarter gone, they did book around $250 million in restructuring charges, some of that relating to the headcount reduction. In other news, Cristiano Amon, the CEO, did confirm that the modem that Qualcomm makes will go into the next generation iPhone that Apple is due to release later this year. But he declined to say whether that will be the case for future generations. Remember, that's been the story, as Bloomberg's reported, Apple increasingly looking to produce its chipsets internally, including modems that Qualcomm currently manufactures.
Ed, thank you, mate. I know we're going to touch base again in about 5 minutes, so look forward to doing so. We're going to talk about Amazon and Apple reporting after the close. The broader equity market, just a little lower, no drama, a mild move lower on the S&P 500, down 0.4%. On the Nasdaq, we're negative here by around about 1/3% also. The sell-off in treasuries continues. The 10-year is higher by 10 basis points. The 30-year yield is higher by 11. The Bank of Japan intervening again this week to slow the spike in yields. We caught up with Jane Foley of Rabobank a little bit earlier.
This is really allowing the market to draw more information about, well, what exactly did they mean last week? So we saw a tweak in policy. To what extent was that, just a technical move to help with the better functioning of markets? Or how far are they going to allow bond yields to push up?
Joining us now to discuss is George Goncalves of MUFG. George, things got very interesting very quickly in the bond market, didn't it? The question I've been asking over the last 24 hours is, what is the dominant factor underpinning this move that we've seen in the last couple of days? What is it, George?
Hey, good morning, John. Listen, I've been warning for a while. When the belly of the curve starts to swing, and it could be swinging from Japan all the way to the U.S., that 5 to 10 year part of the curve is the most sensitive part for all parts of the yield curve, as well as for risk assets. And so, we're experiencing a wrecking ball from supply concerns, from concerns around foreign buying. It's going to slow down, and I think all that's kind of culminating after an environment where rates have been staying under Fed funds for a long time, and that's been the saving grace for all markets, that we've had a very rich 5 to 10 year part of the curve.
How important is Japan's contribution to this volatility, if we can call it that, George, that we've witnessed over the last week?
Look, I think it's hard to attribute exactly. It's the impetus, it's the catalyst, it's the concern about, will Japan start stepping back from buying U.S. Treasuries? But more importantly, it's a global rise in rates. Japan was the last mover of moving away from ultra accommodative policy. It's the early days for this.
So the question I asked George of Ira Jersey of Bloomberg is whether this establishes a new floor for global yields, or if we've got to think about a new ceiling. Which one is it, George?
I think it's a floor, because I think we're also at the same time trying to figure out when is the actual, like the neutral rate for the U.S. 10-year rate as well, with Fed funds, at 5+ rates. If we get a Fed decline in the future in Fed cuts, the Fed's not going to go to zero again. So I think we're trying to figure out, is the floor 3? And I think that this is starting helping that process.
That was what was interesting about the call from Mike Gapon of Bank of America. He made the call in the last 24 hours to drop his recession forecast. But if you go into the note, I think the real call, and Mike says this himself in the research, George, the main difference between our new forecast and prior forecast is in the pace of rate cuts that they're calling for. They think we get another hike from the Federal Reserve, but ultimately when they cut, it'll be in 25 basis point reductions for a total of 75 next year and 100 in 2025. Now, that's 175 altogether. And if you go to 575 and you come back down, he's thinking about maybe 4, George, maybe 4% on Fed funds in the next cutting cycle. George, do you think that's being well priced, well understood by others?
Look, I mean, the bond market has been skeptical, and we've discussed this a number of times before. I mean, that's probably a little bit more than what I would expect, or less than I expect. I mean, I think eventually, what the Fed has done, these long and variable lags, I mean, they're in delay mode. They're not necessarily dead. The transmission mechanism of the Fed is taking much longer, and people are now starting to believe that we can handle these higher rates. That's not what I'm saying. My point is that the discounting of the belly of the curve That's what matters most, and it's been the most mispriced throughout this whole process. So if we get the 10-year staying above 4% for longer, that matters more than where the Fed goes.
George, reasons to believe we can take out last year's highs on the 10-year?
Oh, absolutely. I mean, I think now that we broke that double 408 tight top on the 10-year and today's price action, I mean, a lot of this is setting up for next week's auctions, which are going to be brand new 10-years, which are the even larger 10-years after the auction announcements and the refunding. We're going to, the market's going to probably discount as much as it can to try to get a higher coupon, and then we'll take it from there.
Ton of supply coming from the Treasury. What a couple of days for the bond market. Again, George, it's good to hear from you. George Concalves there of MUFG. Yields up now by 10 basis points, 418 on a 10-year. Coming up, Amazon, Apple, earnings on deck.
To say that those two stocks aren't going to be important is just thoroughly naive. They are going to be very important. You can have a good report and your stock price behaves poorly. You can have a lackluster report and your stock price behaves well. It is all about the share price reaction.
So this is what we're going to do. We'll catch up with Ed Ludlow on the West Coast to break down what he's looking for, what the street's looking for, and we'll get the view from Tom Forte of D.A. Davidson up next.
What's interesting for Amazon and Apple is you're actually seeing a divergence here. So Amazon's call skew is actually very high, meaning, there's a good deal of bullish sentiment. That's actually not true in Apple, which is also very different than the other mega cap techs we saw. So I'll be interested to see how that plays out, because you're actually seeing on those two stocks a divergence in that option sentiment positioning going into earnings.
RBC's Amy Wu-Silverman laying out her outlook for tech earnings. Turning to fresh data first before we get there. Some data crossing just moments ago. Here's Mike McKee.
Well, John, she's talking about service industries, and service industry PMIs are out. Global U.S. services from the S&P folks come in at 52.3. That's down a little bit from 52.4, and the expectation was for no change in 52.4, but we'll call that a 6-inch putt and concede it. It's basically no change. The composite is 52 even, which is exactly what it was last time and exactly what the forecast was for. And basically that's the pattern we've seen around the world today, as service industries for the most part come in the 50s, still showing some strength. France, the only country that doesn't have a 50 handle on their services number, but they're all, except for the UK, in the 40s. In the composite, the UK, which just saw another rate increase today, and a drop in their forecast for growth from the BOE is looking better in the composite, John.
Low bar, UK outperforming. Mike McKee, thank you, sir, for once. Anyway, let's turn to tech. Amazon, Apple reporting earnings after the closing bout. Investors waiting to see whether or not the tech giants can live up to massive year-to-date gains. Ed's back with us with more. Hey, Ed.
Yeah, good morning, Jonathan. Look, from a weighting perspective, Apple is 7.6% of the S&P 500, Amazon 3%. So that comment from Amy Wu-Silverman about what the options indicate, in either direction, we're braced. Apple's interesting. It's a tough macro environment. In the quarter just gone, there were not substantive product updates. So we are concerned about how iPhone has performed, particularly in the Chinese market. We expect an announcement in the current period for the next generation iPhone 15, but we're not going to get details of that in the earnings print or on the call. It's going to happen after the fact. So that's quite interesting. Whatever you use on your Bloomberg terminal, MODL or EEO, the point is that only really the services category is expected to have meaningful top-line growth year on year. In fact, overall, it's the third consecutive year-on-year sales decline we expect from Apple. That's on that side. And then Amazon, I think the story is really about the cloud, John. Microsoft went first, and they are the leading competitor to AWS in that space. They reported sluggish growth. Does that translate over to AWS, which is the cash cow for Amazon, at a time where Andy Jassy is kind of continuing to look across all of Amazon's businesses, reining cost and spending, but particularly on the e-commerce side and things like video that are not the cash cows for that business?
Ed, we'll touch base in the morning. Looking forward to the show later. Bloomberg Technology midday on Bloomberg TV. And on Bloomberg Radio, of course, we'll have the coverage of those Apple earnings after the close at about 4:30, around that kind of time. D.A. Davidson Tom Forday reiterating his neutral call on Apple, 185 price target, saying this: while encouraged by its upcoming Vision Pro product launch and impressed by the sustained growth in iPhone sales, we look for reasons to raise our near-term sales and profit forecast to justify the premium relative valuation. Tom, I'm pleased to say, joins us right now. Tom, is that a very long way of saying you think this run has gone too far too quickly on the stock?
Simply put, yes. So thank you for having me, Jonathan. Always a pleasure.
It's great to catch up with you, mate. Let's go through it. What are you expecting from sales later?
Yeah, so I think the challenge for Apple, as you pointed out, is that you have seen some macroeconomic pressure on their services revenue. And really, it's been the services revenue that's been the key to their multiple expansion and one reason the stock's done so well over the last couple of years. So the question is, can iPhone sales continue to hold up Apple at a time when macroeconomic pressure is hurting services? And it's not clear to me. And then I'm not very excited about the Vision Pro launch next year being a huge catalyst for the stock. So I think that it could be a challenging quarter for Apple.
Tom, let's talk about that challenge geographically. What comes out of China? What are you guys seeing on the ground there at the moment? Because I'm struggling to get a read on that economy. Everything seems to disappoint when the data comes in recently.
Yeah, so when you think about China, it's about 10% of sales for Apple, also very important from a supply chain standpoint. And I do think you saw an initial catalyst following the ending of the COVID-19, COVID zero policies in December of last year. So you saw an initial lift to iPhone sales and to sales in China. But yes, that economy is not doing as well as expected. And that also could slow Apple's growth for both the June quarter and the September quarter. So another potential challenge for Apple.
Can they just get on the call and scream about AI a few times and get this stock to rally, Tom? Everyone comes on and talks about AI. What's AI got to do with Apple's business at the moment?
Yeah, so I think that Tim could put it well when he said it's a vertical technology, not necessarily a horizontal one, meaning it's integrated into all of their devices. You think about the SOS feature on the iPhone. The irony to me is that Microsoft is doing a much better job from a public relations standpoint than Apple, and Apple's as good as it gets at PR. So yes, maybe we'll see a lot of references to artificial intelligence today in hopes that that'll divert attention from maybe some soft numbers.
I've noticed the same thing. It's the PR of AI on the earnings call. You mentioned Microsoft. Microsoft, as Ed mentioned, Tom, the outlook for sales growth around the cloud got a ton of attention. What can we expect to hear from Amazon on the same front later?
So simply put, if we had a scale, and on the left-hand side, we had the initial or incremental sales in cloud computing from AI for Amazon, and in the right-hand side, we had the lost sales from their customers managing expenses, I think it would tilt to the right. Google put it best when they kind of said the same thing, that on a near-term basis, their core customer is managing their spend in the cloud. Longer term, there's a huge opportunity in the cloud as it pertains to artificial intelligence. For Amazon specifically, they reported their slowest growth in AWS since it started in 2006 in the March quarter and indicated that it decelerated 5 points in April. So it went from 15.8 to 10.8. So the question is, did it go from 10.8 to 8 or something like that? I think it's going to be a tough quarter for cloud computing for Amazon.
Tom, I'd love to catch up again over the next week or so. Brilliant research. Enjoyed the research yesterday, just going through it. Is Amazon really cheap anymore? I was thinking the same thing more recently. Thanks for that, Tom. Let's get to the equity market. Equities right now negative by 1/3 of 1% with some sector price action. Here's Abby.
With another decline here, John, we do have more S&P 500 sectors trading lower, not surprisingly, than higher, led by real estate and utilities. This, of course, as yields go higher, those dividends look less attractive. You also have materials, financials, industrials down. Interestingly, consumer discretionary and communication services, two of the up sectors ever so slightly. Consumer discretionary, of course, Amazon will influence after the bell, but into that report down 2.3%. And ahead of that report, Amazon is already the biggest drag.
Abby, thank you. Your trading diary up next. Equities attempting to avoid a third day of losses. We're negative here on the S&P by a third of 1%. That's the price action. Here's the trading diary. Coming up shortly, durable goods, ISM services. Donald Trump is expected to appear in federal court in Washington at 4 p.m. Eastern time. Apple and Amazon earnings after the closing bell. We round out the week with the payrolls report before CPI next week. Stacked lineup tomorrow morning. Looking forward to providing that coverage to you on Bloomberg TV and radio. We'll do that with Rick Reeder, Mohammed Al-Arian, Michael Collins and Anastasia Amoroso. I'll see you tomorrow morning. That does it for me today. Thank you for choosing Bloomberg TV. This was the Countdown to the Open. This is Bloomberg.